Anthony Grasso here, bringing you financial news that you can use. In this particular video, I'm going to do a stock analysis on Root. Is this beaten down artificial intelligence insurance company worth investing in right now? Or even, is it a good candidate to be taken over by a whale? Well, let's find out together. I'm going to go over a summary of the company, its product offerings, recent headline news, financials, analyst projections, and give it my buy, hold, or sell recommendation for both your short-term and long-term growth investors out there. And as always, folks, don't forget to smash that like button down below, definitely helps, and consider subscribing and hit that notification bell for like your daily stock reviews and recommendations from an unbiased source. So let's get right into it. As always, folks, this video is brought to you by Webull, which is an online brokerage trading platform where you can buy stocks, options, ETFs, and cryptocurrencies. If you sign up today and deposit any amount, you can get up to 12 free stocks by using my referral link in the description down below. All right, so what Root does, it provides insurance products and services in the United States. The company offers a direct-to-consumer. It offers automobile, homeowners, and renters insurance products. It operates a direct-to-consumer model and serves customers primarily through mobile applications as well as through its website. Its direct distribution channels also cover digital, media, and referral channels, as well as distribution partners and agencies. The company, by collecting and synthesizing sensory behavioral data across various driving variables, including distracted driving, it prices policies based more on casualty than correlation. It uses telematics, mobile technology, and its digital platform to collect data points that then it evaluates in pricing and underwriting certain of its insurance policies, managing claims and customer support. It acquires customers directly through multiple channels, including digital, strategic partnerships, channel media, and referrals. It was incorporated in 2015 and is headquartered in Columbus, Ohio. So let's look at some of the news of the company recently. So last week, Root shares fell after the second quarter results and the reverse split news that came out. A letter to shareholders posted on the company's website say the last 12 months have been one of the most difficult periods for auto insurers in decades. It also said in the second half of the year, we continue to expect gross written premiums to reflect significant year-over-year declines and operating losses to show year-over-year improvement. That's really bad news. But it's important to note that Root did beat estimated earnings by 7.69%, reporting an earnings per share of negative 36 cents versus an estimated negative 39 cents. But the revenue was down 9.4 million from the same period just a year ago. So let's go ahead and look at some of the fundamentals of this company right now. So the stock is currently trading at $14.71 a share, $15.48 in after hours, with a market capitalization of $208 million approximately. Now the company is projected to have $308 million of revenue for 2022 with negative $334 million in earnings. Now, the revenue is projected to decrease over the next year and end up around $316 million by the end of 2024, with a negative $235 million in earnings. So they're going from a negative $334 million in negative earnings to about $235 million in negative earnings in 2 years. Still not good. So let's look at some of the key measures of this company right now. Because the earnings of the company are not available and are negative, the price to sales and the price to book ratios are the most appropriate valuation measures. Therefore, the company seems inexpensive right now with a price to sales of 0.71 times, below the industry median's price to sell ratio of 0.93 times, which is supported by the price to book ratio of 0.65 times. That is also below the industry median of 1.08. Now, looking at its profitability, based on their operating profit margin and operating profit, and it has a cost structure that eats up a huge percentage of its revenues that is among the highest in any company in the insurance industry. To make matters worse, the company is losing money on an operating basis. Now, their profit margin went from a negative 150% at the end of 2021 to a negative 116% for June 2022. It is forecast to remain unprofitable over the next 3 years and beyond. Now, looking at dividends, they don't pay any dividends, but 52.6% of industry stocks do pay a dividend, though. And then looking at the growth, the CNBC is not reporting it, but although the earnings at Root grew over the past 12 months to be a little bit slightly better, they failed to keep pace with the growth in revenues. This may mean the company is becoming less efficient at using its resources. However, the result was better than that of the average company in the insurance industry. Now, the earnings trend, since it's unprofitable and losses have increased over the past 5 years at a rate of 30% per year. Now, although they have changed the corner because they recently bucked that downward trend in earnings into 2022, it's just slightly getting better. Now, looking at the financial strength analysis for the company, the debt to capital ratio is around 36%, which is in line with the insurance industry's norm, despite its increase over the last year. The company may have difficulty making interest payments, though. Its interest coverage ratio of 8.7 times is among the highest in the industry, but shows that earnings from day-to-day activities are too small to service its debt. But the company's short-term assets of $1.3 billion exceed both its short-term liabilities of $323 million and its long-term liabilities of $656 million. Now, they do have a stable cash runway. They have enough cash for the 3 years based on its current free cash flow, and the forecasted cash runway has the sufficient cash runway for more than 3 years if free cash flow continues to reduce at historical rates of 43% per year. Now, let me back it up a second. So the market valuation for the company is, 200, what did I say up here? It was $208 million. They have $208 million of cash on hand. So, just about. So it's valued at just the cash it has. So, and I'll get into why that's important later on. Now, it is important to note that shareholders have been diluted in the past year, with total shares outstanding growing by 2.4%. So what do the analysts say regarding this company? Well, the analysts have a hold recommendation with 72% saying hold, and there's 18% saying buy. Their average price targets that they put for this company is $32.53 a share on the average, with 90 being the high and a low of 17. And now looking at some of the analyst reports, the Street Quant Ratings has a sell recommendation. This is driven by a number of negative factors, which they believe should have a greater impact than any of the strengths, and could make it more difficult for investors to achieve positive results compared to most of the stocks they cover. Amongst the areas they feel that are negatives, one of the most important has been generally disappointing historical performance in the stock itself. Now, the Ford Equity Research Report has a hold recommendation as a result of their systematic analysis of the three basic characteristics that they look at. They look at earning strength, relative valuation, and recent stock price movements. Now, the company has produced a positive trend in earnings per share over the past 5 quarters. Because the company lacks sufficient analyst estimate data, they place greater weight on historical earnings per share trend as a measure of earning strength. Based on the operating earnings yield, the company is overvalued when compared to all the companies that they cover. Share price change of the past year indicates that the company will perform well over the near term. And then the CFRA report, they have a sell recommendation as well, and it's based on their score of their quantitative model for the United States. So let me bring it back over here. So what are my thoughts? Am I a buy, hold, or sell recommendation on this company? Here are my thoughts. Now, Root is a tech-powered insurance company that is trying to disrupt the trillion-dollar insurance industry right now. I mean, that's their whole purpose. The company has a strong product and uses artificial intelligence-powered telematics to track driver style in real time. Now, Root's model is reportedly 10 times more predictive of driving behavior than the industry standard that anybody else is using right now. In addition, it shows that the riskiest 10% of drivers are 5.8 times more risky than the safest 10% of drivers. Now, the company has reported declining premiums for the second quarter of 2022, and the company is burning a lot of the cash, which is definitely not good. Even though they do have a cash runway, they're just burning cash. They're just lighting it on fire. Now, there is some good news, though. They have a partnership with Carvana, which is one of the fastest growing online used car retailers in the United States. There has been, though, significant year-over-year declines in gross written premiums, and that's projected to stay until 2024. As the company cuts growth and marketing spend money to focus on improving its financial performance and conserving cash. Now, here's some of the downside risk right now that I see. There's multiple years of losses leading to future shareholder dilutions, continued pressure on retention ratios, direct-to-consumer initiatives failing to gain sufficient traction. And there's also some upside risk, though. Retail investors might gravitate to this stock, and the sales expense ratio improving more and or faster than forecasted, driven by more efficient ad spend relative to policy in-force growth estimates. Now, Root right now appears to be in a strong bearish trend. Shares are below a declining 200-day moving average, and the MACD is beneath its signal line. Comparative relative strength analysis shows that this is an issue, this issue is lagging the S&P 500. Now, I do have optimism, though, with the company's earnings prospects. Now, the 2022 revenues forecast fell from 316 million to 308 million, but the 2022 losses are expected to reduce from $26.51 a share to a negative $22.81 per share. Now, the insurance industry in the United States is expected to see an average net income growth of 7% next year. So based on all of that, I am a buy recommendation on Root with a 12-month price target of only $20 a share. Now, guys, normally I would be a sell recommendation all day long. The company is fundamentally flawed with not much upside to the stock price going into the future, in my opinion. I am only a buy recommendation for solely one reason. Because the stock has been beaten down so much that it now looks like a great candidate to become acquired by a whale. This is 100% pure speculation on my part, but think about this. The market capitalization is only $208 million, and that's, they have that in cash on hand. Whoever buys it isn't really going to be losing any money. So Root offers an enterprise white label app, which allows other insurance companies right now to leverage the technology that they have to increase the accuracy of their own insurance underwriting. Now, that seems like a risky strategy for Root right now, because as they are effectively destroying their own competitive advantage. It does offer the potential to become a software backbone, though, of other insurance companies, where Root just leases out the software instead of being an insurance company themselves. I don't know if that's what they're thinking, but that's potentially what might be going on. This is like another insurance can try before they buy the whole company if they wanted to right now. Now, rival insurtech company Lemonade has recently acquired Metromile, which is a smaller competitor to Root, which offers in-car telematics. Now, Root is a much larger and more established, but its declining market cap could make it open for an acquisition of a larger entity, and that's what I'm betting on. I wouldn't buy Root for any other reason than that. This is a purely highly speculative bet that might go wrong. There's a chance that no one acquires Root and they just stagnate at what they're doing for the next couple of years if they can't, get their financial house in order. In theory, Root has an amazing market opportunity and all tools needed for success. However, the execution is what the company has struggled with since going public. Due to the issues with declining premiums and high losses, it could be a value trap for people right now that think they can, that get into it. So risks to buy-in include the competition. The elephants in the room include State Farm, which has the largest auto insurer in the United States, and Progressive. In addition to Geico, which has more than $30 billion in written premiums and is owned by Warren Buffett, Berkshire Hathaway. Recession is a negative. The high inflation and rising interest rate environment is increasing the cost of the consumer, and we're going into a recession right now. Consumers with higher fuel costs, then they might drive less and be less likely to purchase a car, which would impact Root further. But that's just my opinion. What are your thoughts? Please leave your comments down in the description down below. Do you think they're going to be taken over by a whale one day? I would like to see your opinion. So there you have it, folks. And as always, don't forget to smash that like button down below. Definitely helps. And consider subscribing and hit that notification bell for your daily stock reviews and recommendations from an unbiased source. Until the next stock update video later today, folks. Ciao.